India's power demand is surging and so is the need for transmission infrastructure. EPC companies are in a race to build the transmission backbone of India. So, in today's video, we'll look at the top T&D EPC companies, we'll look at the business models. Some thrive on diversification, whereas some on client concentration, whereas some on execution speed. We'll also look at the revenue mixes, margins to help you decode which company is better and which company you should definitely add to investment watch list. So on that note, let's start the video. So in today's discussion, we'll look at four main companies. First is KEC International, next Kalpataru Projects, third Transrail Lighting, and fourth Techno Electric Engineering. So now first is KEC International. So KEC International, this is one of the biggest companies, not just in India, but in the whole world for the EPC. So it does like lots of revenue streams. First, it is the T&D, which is the biggest source. Next, it does civil constructions. Next, it does railway electrification. It also does some water EPC projects, and it also does some oil and gas pipeline projects. So KEC, it is like a very big company. It has diversified revenue streams, and not just in India, but a whole world, like Dubai, USA, Mexico. Like it is a very big company. So as we discussed, company has four main divisions. First is the transmission distribution. Next is the civil. Then we have railway electrification. Then we have cables. And lastly, we have the others. There's the oil and gas pipeline. So the cable business has been written off, or it is transferred to a subsidiary. So now looking at the presentation, the company has a market cap of 18,700 crore, ROE of 8.8% and ROCE of 16%. Now ROCE is somewhat okay, but ROE is depressed because company had recently done a QIP in September 24. Interestingly, which is where the market topped out. Now stock is trading at 41, which is not cheap at all. But next we have the order book. So company has an order book of 37,440 crores as of 31st December 2024. Company is yet to publish its fourth quarter results, and company has debt of 4,300 crore. Now this is one metric that you'll see high in the next company as well, in Kalpataru, because these companies have very long working capital periods. So you see, as we discussed in Genius Power as well, what these companies have is that these companies have a very long execution period, due to which there is high receivables, and if company doesn't manage its trade payables as well, we see a stretch in the working capital, due to which company has to do what? First, take on additional debt, or second, issue equity, due to which we see a high debt in most of these companies. Next, let's look at the sales growth. The 3-year sales growth has grown at 15%, but if you look at the profit, we'll actually see a degrowth of 14%. So this is one factor that you must always keep in mind while analyzing. And now this brings me to business analysis, is that KEC, you need to understand, it is a very capex heavy or asset heavy business. So in business में you'll see margins are very thin. So like for example, its operating profit margin is 7%, which is wafer thin margin. So in companies में जो भी growth आती है, तो ग्रोथ डायरेक्टली टॉप लाइन से आती है. टॉप लाइन यानी वॉल्यूम ग्रोथ या सेल्स ग्रोथ, बिकॉज अनलेस सेल्स ग्रोथ बढ़ेगी नहीं तो ये कंपनी में मार्जिन्स बढ़ेंगे नहीं. देयर इज नो ऑपरेटिंग लेवरेज इन दिस बिजनेसेस. Like this business isn't like a Tyrell type business where once you do capex then you'll see margin expansion. Like you'll see margin expansion by 200 or 300 bips, but that is all. So company का net profit margin is also 2.4, which is very thin. But one thing is that this company has potential with a very good order book, which provides revenue visibility. But one important factor to look out for is the working capital, the trade receivables and the trade payables, because unless these two balance out, there will always be a stretch on the working capital, which will lead to high debt or frequent equity dilution. So as we see the revenue distribution, around 60% comes from transmission distribution. Next we have civil, where the company undertakes civil projects in India. Next is the railway electrification, and here we have the order book split of the company. So power transmission distribution accounts for almost 60% of its order book, and 30% is from India and 60% is from from the rest of the world, as we had discussed. Next we have civil, which is 25%, railways, which is 11%, and others means the oil and gas business of the company. So you see, in the con call also, company had mentioned that it has received year-to-date order inflows of 22,000 crore, and management had guided for 25,000 crore. So management is very confident that it will exceed the guidance they had given for revenue for the order inflows. Next we have the civil business. So civil business mein there's a couple of things. First is the civil projects, and next there's the water EPC project as well. So civil mein why they're going through a downturn is because first there's labor shortage, and second there's delayed payments, or there's not enough cash coming in from the water EPC projects. Next, company is guiding that will increase its revenues 15%. Company is also given margin guidance of double digit OPM or EBITDA margins at around 10% once the legacy orders get completed. So my view on KEC is that I think KEC can remain a very good prospect if you're looking to play the EPC theme. But one thing you must always track is check the receivables, check the debt on its balance sheet, which we'll do at the end of the video, and see the cash flows, because if company doesn't have enough cash flow, working capital management, you'll always see the debt will increase, due to which the interest cost will also keep creeping up. So let's see Kalpataru. As we discussed, T&D accounts for 45%, buildings and factories 28%, water around 8%. So I think the data company has provided, company is yet to publish its Q4 results, so we'll wait for the results. And as for the order book mix, around 37% is from T&D, 22% is from buildings and factories, 21% is from urban infra and water, 14% is from oil and gas, and 6% is from railways. So this and KEC, both of these are very capex heavy, asset heavy, low margin businesses where growth will only come if there's volume growth and sales growth. But one good point is that these companies have diversified business revenues. So even if one segment, that is the water infra, is going through downturn, the other sectors are there to support revenue of the company. So the company itself doesn't go through downturn. So that is a good point. Company has a market cap of 16,500 crores. ROE is 10%, ROCE is 16. ROCE is okay for a capex heavy or asset heavy, but ROE is depressed because company had done fundraise by QIP of 1,000 crores in December. A company has an order book of 61,000 crore, which is much higher than KEC, and comparatively higher according to its market cap. And also company has debt of 4,860 crores. So debt is, as I said, one thing that you must always measure is debt and interest cost on the financial statements. Next, if we look at it, the sales growth 3-year CAGR has been 15%, and the profit growth has been minus, मतलब almost 0% profit growth. So ये भी आपको देखना पड़ेगा कि कंपनी एक्चुअली प्रॉफिट कर रही है कि नहीं, एंड अगर कंपनी प्रॉफिट कर रही है तो वो प्रॉफिट एक्चुअली कंपनी के अकाउंट्स में या फिर कंपनी के खाते में या फिर कंपनी के गले में एक्चुअली वो प्रॉफिट आ रहा है क्या, ये आपको देखना बहुत ज़रूरी है, एंड यू कैन लुक दैट थ्रू कैश फ्लोज. And next, operating profit margins 8.3%, slightly better than KEC, and net profit margin of 2.4%. So both of these companies are good, but one risk, as I always mentioned, is that high receivables, low execution cycle, labor shortage, and all these will have a negative impact on the business. Next, we have Transrail Lighting. So Transrail Lighting, it is an integrated transmission distribution, towers, EPC, and a pole manufacturing company. It also manufactures monopoles, conductors, and structures. So there's three main revenue sources of the company. First is the power transmission and distribution. This includes designing, manufacturing, testing, supplying the steel structures for the transmission towers. As this also includes the substation EPC, similar to what Skipper is doing. So in a way, this company is similar to Skipper, whereas KEC and Kalpataru are similar to each other. So this is how you connect the dots in industry. Next, we have the railway electrification, which is a small part of the business, but still a part of the business. Next, we have poles and lighting. And lastly, we have the civil construction business. And the company also includes to 58 countries. So export market is also big for this country. Plus company का एक project था बांग्लादेश में, but उधर थोड़ा political issues के वजह से project में delay आया था. But now the project is continuing as planned. So in this company as well, 40% of its order book is in India, and rest 60% comes from overseas market. Now, this company mein, what's the issue is that there's heavy client contribution, high client contribution to the top revenues. So as we discussed that KEC and Kalpataru, both of them have a diversified customer base or diversified order book, whereas in case of Transrail, it has a very concentrated order book. So if I have to give the numbers, बांग्लादेश का इनको जो एक्सपोजर है दैट इज अराउंड 66% ऑफ इट्स इंटरनेशनल ऑर्डर बुक विच इज़ अ मेजर पार्ट एंड प्लस वॉर लाइक सिचुएशन एंड उधर भी पॉलिटिकल अनस्टेबिलिटी की वजह से थोड़ा बिजनेस वॉज इम्पैक्टेड. Next, FY24, which is last year, companies yet to publish this year results. The top 10 orders comprise around 64% of the order book by value, but the top 5 projects of the company, they comprise around 40% of the order book. So this is one thing that you must always keep in mind, is that client concentration इधर भी high रहता है. There's always a risk that comes attached with it. Next, if you look at the metrics, a company has a market cap of 6,100 crore, phenomenal return ratios, ROE at 24%, ROCE at 35%, which is best in the industry. Like if you look at it, company recently IPO भी किया था, but it has very good margins, because as you see, this is more of a power transmission and distribution related company only, whereas in case of Kalpataru and KEC, around 40% only was for power T&D, but in this company around 80% is for the power T&D and rest other projects. So this is more a transmission power T&D based company, and within that it is a more tower manufacturer based company. So company has an order book of company has a P of 27, which is cheapest among its peers, and company has order book of 11,500 crore, and company has very low debt, 704 crore, and company is guiding that it will be a net debt company. Its sales growth 3 year has been 23%, plus its profit growth for 3 years has been 32%, which is phenomenal as compared to others, which means that company has not only shown top line growth, company has shown bottom line growth, which is exceeding the sales growth, due to which we can see there's also margin expansion. The operating profit margin for the latest quarter is 13.2%, whereas the net profit margin is 6.8%, which is superior to KEC International as well as Kalpataru Projects. So in my opinion, I think Transrail Lighting is a very very good company, which is better that you have to judge, but I think this is a very good company because it is not only more exposed to a power T&D company, but it is also but it also supplies towers and structures to other companies, as well as also the substation EPC companies. So as you can see from the return ratios, its valuation, sales growth, profit growth, I think this is one of the better companies in this sector. So next company we have is Techno Electric engineering company. So Techno Electric is one of the more diversified business in this sector. So company company does EPC, and EPC में company has three main sectors. First is the power generation. Power generation नहीं बोल सकते, but it is a flue gas desulfurization business. Basically the pollution which is produced in the thermal and coal power plant, thermal and hydro power plant, before it is let off into the before it is let off in the air, there is a process called desulfurization. So company offers that. Next is the power transmission distribution, which is the business we're going to talk. इसमें the company offers installation of EHV substation, which is the extra high voltage substations up to 755 kilowatt. Now there's air insulated substation and gas insulated substation. Next, the company also does distribution system management, that is SCADA, grid management and all that. Next we have advanced metering infrastructure, and lastly we have the STATCOM installation. So as you can see, company like T&D में like जो भी है, company is a wholly integrated player in the T&D segment. Next is the industrial system, where company offers power distribution system to power intensive industries like, let's say, chemicals, steel, etc. Company is also data center business, but data center, it is a small part of the revenue. Plus it is a very uncertain business because there's new breakthroughs every day. So the EPC segment of the company, which is the power T&D, which comprises all the integrated power sector, so that showed a growth of 82% year on year FY26, which also signals that company ka execution is also on point. So let's look at Techno Electric. Techno Electric has market cap of 12,390 crores, ROE of 13%, which is good, ROC of 16.5%, which is also good. P trades at around 38 times, which is a bit expensive, but not as expensive. The order book of the company is around 9,700 crore, which is also good. The P, if you look at it, the P is around its 3 years median P, which is 42 times. So it is trading below its 3 years median P. So company is debt free, which is a very very big green flag in this company. Ki company doesn't have debt, We'll also look at the trade receivables and payables, which no debt basically means what? That company is able to execute all of its projects, all of its operation without taking debt. Means company has enough means company has good working capital management. Company has enough cash on its balance sheet to fund its operation. And no debt means also what? No interest cost on the P&L. Like if you see at KEC, Kalpataru and all these companies, so these companies may the interest cost keeps creeping up over a period of time as we look ahead. But this company is debt free, which is a very good green flag. Next company 3-year sales growth is 20%, phenomenal. Profit growth 3-year 20.5%. This also implies that there has been margin expansion. Operating profit margin 14% and net profit margin at 15%. Means in this sector, means within the whole industry, so Techno Electric has the best margins. Now let's head on to Screener to analyze these companies in depth. So KEC International, similar to Genius Power, this is a more of a narrative based story, and as execution comes up, as the financial statements come up, we'll see companies doing better. So what I wanted to show is that top line growth has been okay, but last few quarters profit growth has also come back. So if you look at it on a trailing 12-month basis, the profit growth has been very good. Like if I show it to, yeah, almost 70%. Company has shown good profitability as well. One red flag that I want to highlight with this company is that, wait, let's see that I'm not here to give you blind buy or sell recommendations. My motto is to give you both the positives as well as the negative to help you make informed decision whether you want to invest, because this is hard-earned money and it is better to remain informed that about both the risk factors as well as the growth drivers. If the growth drivers remain intact and the risk factors they slowly start decreasing, then no worries. But if the risk factors start to wane and the growth drivers slowly weigh off, you always need to keep in mind when to exit a stock. So one example of a red flag that I want to give you is that if you look at it 2 years ago, almost 3 years ago, company had interest of around close to 100 crores. But now if you look at it, the interest cost has ballooned up to 170. So almost a 70% increase in interest cost. This is what leads to decrease in net profit and PAT. And plus, if we look at it on the balance sheet maybe reserves have increased, but the debt that has also increased. Main point is, see, look at the trade receivables. Trade receivables, they have remained constant around 5,000 crores, and it is actually decreased, which is a good point. Okay, trade receivables have decreased. Cash flows maybe, see, receivables which were very high 2023 2024, इसकी वजह से profitability of the company was also very low, plus the payables have also increased. So this will lead to a better ROCE of the company. Like if you look at it, 12% से ROCE improved to 16%. Why? Because first, trade receivables decreased and trade payables increased. Understand it this way, trade receivables are current assets. So if current assets increase, the cash balance of company decreases, whereas trade payables, which is a current liability, if current liabilities increase, the cash balance also increases. So company has better working capital, right? Plus FIIs have been buying the stock. So if you're someone who likes to track FIIs and DIs, this stock can be on your radar. Transrail Lighting, it is a newly listed company, so इसका थोड़ा data available नहीं रहेगा. But if you look at it, company is in line with 3 years and 5 years P. PEG company का दिख रहा नहीं, but at its current valuation, I think Transrail Lighting is a stock that must definitely be on investment watch list. Plus company has shown very good growth rates, 11%. Company is now guiding that it will maintain mid-teen margins around 13-14%. Plus profitability has also increased by a good margin. One thing is that company का interest cost has broadly remained the same. No doubt 43 से 49 increase हुआ है, but it has broadly remained the same. So there's not a very exponential jump in the interest cost. Trade receivables have largely remained the same. Plus बांग्लादेश के वो डील का थोड़ा impact आ सकता है, but broadly its trade receivables have remained the same. Plus borrowings, they haven't increased at a very alarming rate, like normal borrowings have increased. Plus if you look at the cash from operations, its receivables have increased in March 2024, but we'll wait for the results to for the Q4 results to come in and will be better able to analyze it. Plus company has good ROCE. So Techno Electric 38 times earning. It is trading at discount to 3 years P, but not to its 5 years median P. Plus company में interest cost no, इसमें कोई issue है ही नहीं because company is debt free company. Plus so KEC का analyzed order inflows, that is at an all time high, around 29,000 crore company has received in 2026. Plus order book as a percentage of sales, if you look at it, Kalpataru has a higher percentage of sales, means on a sales basis कि company Kalpataru has 267% more order book than its sales that is doing currently. If you look at it, सबसे ज़्यादा तो Transrail Lighting का है. Transrail Lighting का it is around 288%. So that is a very good thing. Plus, so if we are Techno Electric का सबसे highest, it is around 560%. So Techno Electric and Transrail Lighting, they have the highest order book as a percentage of sales. Now, seeing for order inflows, this has been nice. So with this, we'll move on to the conclusion of the video. So what we saw in today's video, we did a P2P analysis of the different businesses, KEC, Kalpataru, Transrail and Techno Electric. We understood the different business models, like for example KEC and Kalpataru, it has a more capex heavy, asset heavy, low margin, volume growth based business, whereas Transrail, it is a more power transmission and distribution pole based company. So EPC thoda sa kam hai, but it is forward integrated into EPC, whereas Techno Electric, it is a very diversified business, and Transrail, it is a more concentrated business, and Techno Electric more diversified, but is diversified within the power sector as well as the data center. So if you ask me, in my opinion, I think Transrail Lighting and Techno Electric, these two companies can do really well in the future, because as we saw, Transrail Lighting, good return ratios, low debt, Techno Electric, no debt, good return ratios, plus future prospects. The data center business of the Techno Electric, that is a bit uncertain, but I think that within the four, I think Transrail Lighting and Techno Electric, these two can do really well as compared to Kalpataru or KEC. So this marks the end of the video. I hope you guys liked the video, found it informative, and if you found it informative, make sure to like and subscribe, share it with your friends and family, and comment down below which stock you add into your watch list and which stock you want me to analyze next, or which sector you want me to analyze next. So on that note, let's end the video. Thank you.